At IBCanada Group, we are your complete and independent source on the infinite banking concept, serving Canadians from coast to coast.
Finance Minister tabled her second budget on April the 7th. So brace yourself for some good news, some bad news, and some great news. The budget has such a heavy focus on housing that it may easily be called a housing budget. The best news of all, the government did not raise personal tax rates, nor did they increase the capital gains inclusion rate from the current 50%. And there's no real change to the principal resident exemption, at least for now. Having said that, the government is concerned about those high-income individuals who pay little or no income tax because of various tax credits and deductions. We already have alternative minimum tax since 1986, but it hasn't been substantially updated. Budget announces that the government is going to revisit a new minimum tax regime to make sure that all Canadians pay the fair share of tax, and it is expected to claw back some of the benefits and tax advantages claimed by high-income individuals. More details will come in the 2022 Fall Economic Update. One good news is that the budget has a huge focus on housing in general. To help Canadians save for the first home, the budget proposes to introduce the tax-free first home savings account, which allows Canadian residents who are at least 18 years of age and have not lived in a home that they owned either in the current or preceding 4 years to contribute up to $8,000 per year. The maximum lifetime contributions to the account is $40,000. Unused annual contribution room could not be carried forward, meaning that an individual contributing less than $8,000 in a given year would still only have an annual limit of $8,000 in subsequent years. Contributions to the plan would be deductible like an RRSP, and income earned in the plan would not be subject to tax like a TFSA. Withdrawals from the plan to purchase a first home would not be taxable, but withdrawals for any other purpose would be. For someone who qualifies for the eligibility definition and is thinking about buying the first home, the tax-free first home savings account will be a way to jumpstart those savings. Withdrawals from first home savings account and home buyers plan cannot be made for the purchase of the same home. If the funds are not used to purchase a home, they may eventually be transferred to an RRSP or RRIF. The plan must be closed if the funds are withdrawn to purchase a home or the plan has been in existence for 15 years. The full annual contribution limit would be available starting in 2023. Quite possibly, the worst news is reserved for those who buy and sell or flip principal residences and rental properties after 2022. Gains on the sale of a home within 12 months of purchase will be taxed as 100% business income, not a capital gain, and will not be eligible for principal resident exemption. Exceptions will apply to certain life events like death, separation, or divorce. This anti-flipping rule would apply to residential and rental properties sold on or after January the 1st, 2023. Besides flippers, the budget also targets speculators and foreign buyers. New rules would prohibit foreign commercial enterprises and people who are not Canadian citizens or permanent residents from purchasing residential real estate in Canada for a period of 2 years. Certain exceptions will apply to refugees, some international students, people with work permits, etc. The restrictions would not include recreational properties, such as cottages and other vacation homes. In terms of the tax credits, federal government is doubling the first-time home buyers tax credit from $5,000 to $10,000. And the home accessibility tax credit from $10,000 to $20,000. There is also a new tax credit of up to $50,000 to support home renovation for multi-generational homes. You can take advantage of this new tax credit if you plan to create a secondary suite for a senior or an adult with a disability. Good news for those Canadians who want to become parents. The government also proposes to expand the definition of certain medical expenses and fees that individuals trying to become parents may incur. These include expenses related to surrogacy procedures, fertility or donor bank clinics. These measures would apply to expenses incurred in 2022 and subsequent years. On the small business side, there are no changes in the small business rate, nor the federal active business income limit of $500,000. Under the current tax rules, up to $500,000 of the active business income of a small business corporation benefits from a reduced rate of income tax, but the income cap is reduced once the taxable capital employed in Canada of the corporation and associated corporation exceeds 10 million and is reduced to zero once the taxable capital hits 15 million. Budget proposes to increase this taxable capital range so that the income cap is reduced to zero only when the taxable capital employed in Canada reaches 15 million. This change would allow more medium-sized CCPCs to benefit from the small business deduction. This measure would apply on or after April the 7th. Government is also targeting the non-CCPC planning, which is the planning method that used to avoid CCPC status by structuring a private corporation under a foreign jurisdiction while maintaining the company's Canadian residency by keeping its central management and control in Canada. By doing so, its investment income would be subject to tax at lower rates instead of the high refundable tax rates applicable to CCPCs, cutting the tax payable by the corporation almost in half. This practice is likely over as of April the 7th, and the government will tax non-CCPCs just like any other CCPC corporations. And that's the highlights of some of the tax changes in 2022 federal budget.
IBCanada Group, your independent authority for information on the infinite banking concept.